Welcome to Market Week in Review for the week ending August 6th, 2021. I'm Chris Collins. Today I'm joined by investment strategist Alex Kuzley. Hope you're faring well despite the lockdown and winter weather in Sydney, Alex.
Yeah, things are pretty good, all things considered, Chris.
Good. Well, hold tight. Hopefully you can find some meaningful moments in the coming weekend. Now, I know we have a number of topics to touch on, from yields to recent activity in China, so let's jump in. Kicking off, Treasury yields have continued to fall this week. German bonds went negative across the curve. The Bank of England met to discuss their approach to rates and bond buying. It seems like we're at an inflection point right now. What trends are you seeing, and what can we expect over the next 18 months or so?
Yeah, sure, Chris. So yeah, we have seen kind of this continued trend of lower yields. I think your point in Germany, 30-year bonds went negative. In the US, real yields have kind of kept moving lower. I mean, the last 2 days we've seen a little bit of a bounce back higher, but yeah, that trend is still seems to be intact. Our view still is that we think that this 150 to 200 basis point range on the US 10-year seems about right to us. And I think that right now, what is driving the bond market, there is parts of it there is some positioning changes. And when we look at measures like the CFTC provide measures of 10-year positioning, we've seen that move net long now, and it's probably as long as it's been in the last 4 or 5 years. So to us, that shows that we have seen this move away from short duration, and we're starting to see not crowded positioning, but we're getting towards that part. And there also is the Delta scare. I think we've talked about in previous Market Week in reviews, that we do think, is a risk to monitor, and particularly in Asia and obviously in Australia where I am, it's causing a bit of problems for the economy. But for the Northern Hemisphere, we think that the risks are still fairly limited from the Delta outbreak. And so as we get through this, we do think that catalyst will come through to see those interest rates start to move higher. We're not going back to, really high levels, but we think that 150 to 200 basis point range over the next 18 months seems about right to us.
Switching gears, let's maybe look at the regulatory and economic activity happening over in China. Now, first, related to what Paul and Julie spoke to last week, the China crackdown narrative further intensified this week as Tencent was placed sort of in a spotlight of its own. From your perspective, is there anything off limits? I know that there's been government mandates that's extended beyond tech. There's been education, property. What are these mandates having on the current outlook of Chinese investment?
So I think that there are two key things right now in China that I think are risks that aren't going to go away. So the first one is around the way that China think about foreign investors coming into China. So they have a structure, or most Chinese companies have this structure called a variable interest entity that is generally listed in the Cayman Islands, and that gives US investors access to Chinese equity. And that isn't strictly legal in China, but they've kind of accepted it and let it go on. And it seems like they've become increasingly uncomfortable, and they would like over the longer term to see those capital raisings occur in Hong Kong and China rather than other countries. So I think that element is going to stay around with us for some time. And I think you're going to see a little bit more of a risk premium for foreign investors into those companies because of this way that, the development of China's thinking. The other part that is kind of slower moving, but also very important, is I think that, at the base of the Chinese government's thinking right now is that, those companies that do consumer tech aren't viewed particularly favorably. That it's not viewed as strategically important, or that, even necessarily productive use of assets. And so I think at the margin, they would like to see, assets and resources move away from those at the margin towards those areas like artificial intelligence, electric vehicles, carbon reduction, those areas that are strategically important. And I guess, and the third part of this, and this related to education, is, the focus on inequality, particularly with the People's Congress coming up next year when, Xi will cement a third term, provided nothing goes wrong. That focus on inequality is also going to remain. So education, property, healthcare, those are the kind of areas that are going to remain in focus there, we think.
Completely agree. And so relatedly, from a political, economic perspective, there was the Politburo meeting over the past week as well, which effectively is the quarter economic policy review. Any key takeaways as it relates to fiscal or monetary support for the back half of this year, or anything else of note, maybe infrastructure? Open your comments.
Yeah, sure. So I think, going back before the Politburo, one of the things that we've, observed and has occurred has been that the Chinese credit impulse or the credit flow was tightening, and it tightened faster than I think the government were really comfortable with. And we saw the People's Bank of China cut the reserve requirement ratio last month. So that kind of monetary easing at the margin has already started. And we think that should start to, kind of let the credit growth start to bottom out. And then on the fiscal side, we've had a fairly slow issuance of local government bonds. They have a quota each year, and it's been running slower than normal. And I think the Politburo, the main emphasis is that is going to pick back up as we had expected. Fiscal support is going to be maintained. And I think that the big part is the infrastructure and the fixed asset investment, which is their big swing point that they can actually get to try and increase their activity. So I think that at the margin, both fiscal and monetary are going to become more supportive. And then we also got through the week, we got the PMIs from China. So a more timely gauge of how the economy is going. And there, I think we have seen this general slowing continue in both manufacturing and services. And I think in manufacturing, we saw new orders both domestically and the export orders slowing. So I think that kind of increases that incentive for the Chinese government to just not go into a really big loosening, but just kind of at the margin incrementally loosen policy.
A definitely watch point for not only this month, but the remainder of the year. So with that, I believe we're at the end of our time. Thank you so much for your insights, Alex. Hope you enjoy your weekend ahead. To all listening, stay safe. Enjoy what remains of your summer or winter days.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.